Good afternoon. Thank you for joining us today for Rethinking Asset Allocation, a one-hour webinar sponsored by State Street Global Advisors. My name is Dave Nottig, and I'll be your host for today's webinar. For those of you who don't know me, I'm the Director of Research at indexuniverse.com, as well as the Journal of Indexes and the Exchange Traded Funds Report, the longest-running ETF-focused newsletter in the world. I'm very excited about today's webinar. It's one of our most requested topics at our conferences, on our website, and emails, people walking up to me on the street. We get more questions about fundamental asset allocation decisions than pretty much anything else at our publications. The format for today's webinar is pretty simple. I'm going to start off with a brief presentation touching on some of the background of modern asset allocation programs. But then I'm going to take a break from that, and I'm going to talk about some of the very real problems that those basic asset allocation models have, and dig into some of the flaws in both the methodology and the inputs. But then we'll talk a little bit about solutions and how some advances and some new thinking might help you build better portfolios, better manage risk, match your portfolios to your expectations. And my hope is that by the time we're done, you can walk away with some real-world practical solutions for your asset allocation dilemmas. Obviously, there's no right answer for every investor or for every client, but I think there are some ways to avoid some of the woolly thinking that plagues so many people in the asset allocation process. To help us drive towards those real-world solutions, I'm thankfully going to have some help. After I make my short presentation, I'm going to bring in my panelists for a roundtable discussion, which you all can participate in. First, I'm lucky enough today to be joined by Tom Anderson, who's the head of ETF strategy and research for State Street Global Advisors. Tom comes from the product development side of the business, and I think having that perspective will be helpful today because issues like asset correlations and finding good sources of data, those are near and dear to his heart every day. Second, I'll be joined by Sean Clark, who's the CIO of Clark Capital Management Group. Sean will be giving us a real-world perspective on how the role of asset allocation has really evolved in managing client portfolios, including some concrete examples of things you might be able to do to help improve your own clients' returns. A few quick housekeeping items before we get started. As a participant in this webinar, you can submit questions for me or for my panelists at any time during the presentation by entering them into the Q&A window on your screen. We'll collate the questions and answer as many as we can during the Q&A period. A replay of this presentation and a copy of the slides will be available both at Index Universe and at spdrsspiders.com within a few days. And for those of you who are viewing this live right now on April 6th, information on how to apply for CE credits will be contained in a follow-up email that will come a day or two after this. And with that, let's go ahead and get started. In fact, let's start all the way back in the beginning. And when we talk about asset allocation, the beginning is actually about 1986. In 1986, Gary Brinson and two colleagues wrote a paper called The Determinants of Portfolio Performance, which was published in the Financial Analyst Journal. And the questions they looked at were really pretty simple. They looked at the historical performance and the portfolios of 91 large pension plans over a 10-year period. And they asked, basically, why did one fund succeed and another fail? And famously, they concluded that 93% of the difference in performance between these pension plans could be attributed to basic differences in asset allocation. That was the sort of fundamental of the discovery. Unfortunately, things went awry with the public understanding of that study almost immediately. The Brinson study has become probably the most widely quoted academic justification for asset allocation, and certainly modern asset allocation. And indeed, the Brinson study is probably the most widely cited financial study in the world of any kind. And most often when people discuss that Brinson study, you'll hear something like, asset allocation is responsible for 90% of your returns, which is kind of not what the study really said. Performance and variability in performance aren't the same things. And one of the biggest misunderstandings about that is that their work, that early work, really looked at the performance of a group, and it doesn't necessarily apply to individual returns. In fact, what the study did was it averaged plan performance. So for any one individual pension plan, security selection or market timing could have had a huge impact on performance. But Brinson confirmed that these impacts did balance out when you looked at all of them. The negative of one would be offset by the positive of another. Still, it made a very strong case for asset allocation using index products as a sensible approach to the markets, and that's the legacy that's persisted. The second thing that people seem to forget when discussing this study is that in academic finance, just like in real-world finance, past performance is no guarantee of future results. How many times have we heard that? And this study really just looked at 10 years of data, and a very specific 10 years of data in a fairly rarefied part of the marketplace, the pension fund business.